Chris, he's with us. Chris, sorry for the delay. Sorry to have kept you waiting. Can you just tell us what's your outlook on the crude prices after the fall yesterday? What are the next few events to watch out for?
Yeah, indeed. I mean, I think we saw a sell-off yesterday. The speculators have had record net length in the market. And as I think your introduction said, Libya returning with the blockades being lifted, that's added 300,000 barrels a day to the market. We've got some concerns about trade tariffs and what that might have on GDP and therefore demand for oil. And as you said, it's a question of how much oil are we going to lose as a consequence of Iranian sanctions. Now, for me, the fundamentals haven't changed substantially. What we didn't talk about with this sell-off is that we saw record draws of crude in the US yesterday as well, over 12 million barrels a day. So fundamentally, the market still remains relatively tight. And our view is that we'll see 1.3 million barrels a day of Iranian oil disappear off the market when we get to November as the sanctions hit. Absolutely, we're going to see softer implementation. And this is really the US's administration's fear of high oil prices. They've tried everything they can do to get as much oil put onto the market by OPEC, but they realize that OPEC simply doesn't have enough spare capacity to make up for a fall of all of the Iranian capacity. So we are still in a relatively bullish market with relatively tight fundamentals, but this softening of the approach to Iran does mean that it's probably going to be a smoother transition and less of a price spike that perhaps some of the market was expecting come November.
You're saying that it'll be a smoother transition or smoother execution as you were expecting. You don't expect prices to go up much from here?
I think prices are likely to rise a little bit as we go into November, as we do see crude coming off from Iran. We're already seeing the Europeans take less. Secondary sanctions on banking means that refiners and traders who have got exposure to US banking are already taking less crude. So we are still going to see some tightening and firming of the supply and demand balance. But as the fact that it's going to be happening around November, that traditionally is a period of higher refinery maintenance and therefore lower demand of crude. So it should be a smoother transition that we're expecting. Probably oil prices likely to trade around $75 to $80 mark. We think there is enough supply in the market not to need to see oil prices rising to above $80 and into the $100 range, which would be the price you would need if you would need to see some demand constraint be put onto the market. That doesn't feel now necessary, and therefore the call on demand for oil feels around the high 70s is about the right place for oil. So a little bit of an oversell sell-off yesterday, likely to see firming as we go forward.
Yeah, Brent, futures already up by $1 as we speak. So we should expect prices around $75 to $80 is a view coming in from S&P Global Platts. Hi, Chris. This is Nantara joining in from New Delhi. I know you love crude. You were earlier with Shell, etc. But I want to talk about other commodities as well. I want to talk about metals and what's happening, with metals around the world. Look at the sell-off that we're seeing. It's, of course, part of that trade war. What's your outlook when it comes to metals for the rest of the year?
Yeah, metals is not necessarily my expert area, but I think, as you say, it's suffering from the same concerns around the trade war. The trade war has first hit the metals market. That creates huge uncertainty. It's creating higher prices. That's also giving some concern around GDP growth. Already we've seen GDP growth forecasts perhaps softening by about 0.2%. All these things tend to have an impact on commodities. It's hitting the metals market first. It started to have an impact on oil, but again, the fundamentals are relatively strong on the oil side. The metal side, I think, is an issue again around supply-demand economics and how far the sanctions really and tariffs do hit and bite into those commodities. I think I heard in your earlier segment, nickel prices are probably the ones which have been the most resilient in this period. And that's an interesting one because, of course, it's the link between metals and oil and energy, because of nickel as being a significant component used in batteries. And with the rise of electric vehicles and batteries, we're seeing between nickel, cobalt, lithium having far more support. An interesting relationship there between energy and metals.
So are you therefore expecting money to flow into the energy market, you know, in these commodities like oil and gas and crude from the metal pack? Could that be something that we should, that we could expect? And my second question to you is that, you know, when you're talking about a trade war, Donald Trump in the past has indicated that he will ensure stable oil prices. So perhaps a ramp up in shale gas in the US, is that likely?
He certainly would like to have more stable prices, but the reality is that he's doing everything but helping that with these tweets which move the market so significantly. The market is very finely balanced, so it takes just a little bit of disruption or a little bit of uncertainty around demand to create relatively large moves as we saw yesterday. The US, when it comes to shale oil, is already producing 2 million barrels a day more this year. That's 1.4 million of oil, 0.6 million of what we call natural gas liquids, the lighter cut from the barrel, and a lot more gas. Gas Henry Hub prices have pretty much flat-lined. They are fairly much trading in a range around $2.75 per MMBTU, and likely to stay there. There's plenty of low-cost gas that can come out of there, and it's really a question of when new liquefaction capacity is going to come on, which would stimulate a bit more demand. But certainly, the US is not. People talk about the US being a swing producer. The reality is it can bring on new oil relatively fast, but those producers, they're running as hard as they can to produce as much oil as they can today and haven't got much more capability to bring more on. They're constrained by resources, pipeline takeaway, gas handling capability. So they're really at the maximum what they can do right now.
Right, Chris, a pleasure talking to you. Thanks so much for taking the time out and joining us here on ET Now with your outlook for the commodity markets, particularly as far as the crude markets go.